Dogs.
Top dogs.
Top Dogs 2022, managing positions. This is a series we started in 2016, and people liked it. They watched more than a couple million times where it was watched, and we decided that we'll revisit it in 2022. Mm-hmm. So today's segment's on managing positions, but can you go to the first slide, please?
Sure.
The first week we did core portfolio. First of all, let's see what time it is, 9:09. The first week we did core portfolio and product indifference. The next week we did capital efficiency and allocation. Last week we did cost basis reduction. Today we're doing managing positions, and they're all just, they're pretty wide topics. And next week we'll do scaling up and down. This is the kind of stuff that people write us a lot of emails about, or variations of this kind of portfolio management type stuff. We're using a $100,000 account as the basis. We're using about 50% of the money. So on a $100,000 account, we're using about, I think last week it was 47,500 or 48,000 of the 100,000. We are passively managing the positions, which means for us, we're only making adjustments once a week, which is way less than we would normally do. And the positions are pure directional. So what it is there's subjective directional positions of just things that I like or don't like. So they have nothing to do with trying to be delta neutral. It has nothing to do with it. It is trying to be non-correlated, but like the directional risk I'm taking there is just my directional risk. You guys might think differently. Like I'm long euro in here. I'm short crude oil, things like that.
Right.
And, I think, we'll take a look in a second. I think we're long bonds too. But we're fairly aggressive with being very directional. And I think that is the key. That's one of the key takeaways. Let me just check on these bond positions to see where we stand. That's one of the key takeaways that I want, people to kind of grasp, is that we're not just putting on stuff for the sake of just having high volatility. It's a combination of what you would do if you were putting together a portfolio and you said, hey, you know what? I want to be long China, or I want to be short China. I want to be long the British pound, or I want to be shorted, or I want to be long soybean. Like we're not saying this is just this market neutral position. We're going after a bunch of direction, and we're not trying to make it a P&L thing. We're trying to make it a more of a reduction in volatility and how to manage, a little bit
the
more.
Overall volatility of the portfolio.
That's right. Let's go to the first slide. So this is the position that we have on now. Now, again, this is a $100,000 portfolio. We're using in somewhere under $50,000 in cash. I'm not exactly sure what it is total today. We'll bring that up in a couple slides. This has a bullish S&P position on. It has a bearish NASDAQ position on, which of course, today would not be working great. Sure. It has a neutral Russell position on. That would be working fine. Why did we do bullish S&P and bearish NASDAQ? No reason. We just had to pick something. So we went bullish, bearish, neutral. It has a bullish China position on, covered call in there. It has, which is working nicely today. It has a bullish Euro position on, which is today, which today is about a wash. It has on a bearish crude oil position, which today is working fine. And it has a bullish Bitcoin position on, albeit small. Today, Bitcoin's up a little bit, so that's good today. But I just wanted to show you, there's not that much that's what we call neutral. There's one neutral position here, the Russell, which is short of strangle. The rest of these positions are bullish S&Ps, bearish NASDAQ, bullish China, bullish Euro, bearish crude oil, bullish Bitcoin. Okay, so there's directional risk.
Sure.
Okay? I'm not trying to wuss out on this thing. We're trying to be aggressive. Let's go next slide, because we think people have opinions. Week one, when we put this on, the market was up 4.5%. Week two, the market was down 3.8%. Week three, the market's down 3.3%. And so total since we put this on, the market's been down 3.1% and volatility's been up 6.3%. This is a short vol portfolio, so that's moved against us. And this is what turns out to be a delta neutral to slightly long portfolio. So that's moved against us a little bit, but we're just pointing out what the market's done. And those are some fairly large moves over the last 3 weeks.
For sure.
Let's go to the next slide.
And I like the comparison looking at it in the past weeks, how it was much tighter. And you can see that the volatility was much greater the last couple of weeks.
So we originally put these positions on in September. So because we're managing these positions on a weekly basis, we just rolled them last week to October. Now, why did we roll them last Wednesday? And the reason we did is because last Friday was 21 DTE. And if you're going to default to the optimal time to roll, Tony and I always preferred to choose a day or two earlier than a day or two later.
Sure.
Okay.
Sure.
It's a reduction in risk.
I think we've talked about that at nauseam at time throughout the show, for sure.
When we rolled the position, we also recentered a lot of them. So in other words, we went back to kind of like the original delta. So you can see here, the SPYs were long 30 deltas. The Qs were now short 47 deltas. IWM was completely flat. FXI was long. These are beta weighted to the S&P deltas. The FXI, which is large cap Chinese stocks trading in Hong Kong, long a total of 6 deltas on a covered call. 6E, which is our euro position, long 31 deltas. XOP short 93 deltas, as measured by the S&Ps, and Bitcoin long 13 deltas. Net, we picked up $4,410 in additional credit, and we are short beta weighted right now 60 deltas, our entire portfolio. So the whole portfolio is short 60 deltas. That's pretty small position for a $100,000 portfolio. When you think about a $100,000 portfolio, for us, a normal directional bet on a $100,000 portfolio is usually somewhere between 200 and 400 deltas. So 60 deltas is a very good non-correlated portfolio with a small amount of risk. That $4,400 number, we are trying to take about $1,000 plus maybe $1,100 or $1,200 out of that number at the end of the month. Gesundheit. So our goal on this position is have the positions work for us, have volatility collapse, have the positions work for us, and at the same time take out some of the volatility, which about 25% of that number of the 4,400, and also hopefully the direction works for us too.
Sure.
We're hoping for like if you think about this, if you straight line this over 12 months, you're trying to take 12% plus out of your volatility play, and which is about 1% a month on top of that, you're trying to, be right directionally. Let's go to the next slide. So we wanted to show you by managing positions, because this is a managing position segment, we wanted to show you, hey, what does it all mean? So the underlying, just as an example in the SPY, before the adjustment, after 2 weeks of having a position on, it was 48 SPY deltas. After we made the adjustment, we knocked it back down to 30. And as of 8:30, it's now 43 again. See, I'm just showing how positions move around.
Sure.
The Qs went from minus 32 to minus 47 back to 23. IWM went from being completely flat to long 23 deltas. The FXI stayed the same. The 6E went to almost zero. The XOP went to only 39. And the BITO remained where it was. So net on the week, we picked up 28 deltas. That is a very reasonable number. If you can keep your number on a weekly basis, like when you're thinking about how much, remember, this is a $100,000 portfolio, okay, with a significant amount of risk. We're not suggesting that it doesn't have any risk, but our entire position moved 28 deltas. That's 28 shares of SPY over the course of a week.
Right.
I don't think there's anybody watching with
a $100,000 portfolio who's going to look at a 28 delta and say, man, we're taking a lot of risk.
I don't think there's anybody watching that could say with a $10,000 account that 28 deltas would throw you off your game. So I think that on a $100,000 account, 28 deltas. My whole point here is that that's a very manageable number, 0.25% over the course of a week in portfolio, how your portfolio moved.
Mm-hmm. Mm-hmm.
And it could have been up or down, whatever it is. And
Sure.
I'm not even suggesting how, I mean, obviously the portfolio had a good week, but this is not about P&L. So what we're trying to do here is just impress upon the fact that you can have 7 different positions, all fairly equally weighted, using almost the same amount of capital. I mean, XOP position uses a little more capital than the other ones, but generally speaking, we tried to weight these based on capital, based on delta. And you can see by making these adjustments. Now, we make these adjustments once a week. In our normal trading, we make them more often than that.
Sure.
So we're even tighter than that. And the purpose for this is to show you that what we're doing is very scalable.
Mm-hmm.
Let's go to the next slide. So the next thing we did is we went to look at probability of profit, because by managing positions, what does that mean? So last week we had a portfolio correlation of 0.45 to the S&Ps. What we wanted to do is keep that correlation as low as we can to 0, because a non-correlated portfolio is actually much better for us. So the cool thing here is that we went from 0.45 last week to 0.35 this week, because after we managed all our positions and made our portfolio adjustment, we actually were able to kind of move closer back towards that 0 number on portfolio correlation. The reason you want to be closer to 0 is then you don't have this correlation risk, and if whatever the market does, you're independent of that. What you can also see here is that by managing our positions on 823 to 830 in that 1 week, we were able to improve our probability of profit in IWM, 6E, XOP, and BITO dramatically. So the other 3 stayed the same. But when you manage your positions and you make some very minor adjustments, you put yourself back into a position where you have a higher probability of profit. So we reduced our correlation. We increased our probability of profit. Now, I'm guessing the market accommodated us, which it did, because we were small short deltas and crude oil came down a little bit, euro went up a little bit. So the market accommodated us. But my point is, you see the 4 green spaces, all of those are where the probability of profit went higher.
Yeah, it's awesome.
So by making these adjustments, can you go back one slide?
And you still have a high probability of success on all the other trades too, which is...
Yeah. So when you go back one slide, I go back to these managing positions, the beta weighted deltas. The deltas, we reduced, over the course of the week, we reduced our delta risk. Remember, before adjustment would be 136. After adjustment, it was only 60. And then negative 60, and a week later, it's plus 28. So we basically reduced our overall portfolio risk. And then go forward to the next slide. And in the process of doing that, we also gave ourselves a higher probability of pop, which is probability of profit. And then we reduced our correlation risk, by almost 25%.
Mm-hmm.
So they're even more aggressive than this. So ourselves. Mm-hmm. Let's go to the next slide.
I mean, listen, it's hard when you're doing something for show, like not to have your own personal opinion on something. I mean, everybody who trades has their own personal opinion. We're trying to stay right down the line here and be mechanical with everything that we do. Now,
here, we'll keep moving forward here because this is really interesting. So now you get to the capital allocation piece, and you're thinking to yourself, well, in September, as we were getting closer to expiration, what happens is that you, before we adjust positions, and we actually had more risk on, which meant we were using $48,000 in capital. After we rolled the positions, we reduced the risk of the portfolio by managing the positions, but we also reduced the amount of capital.
Mm-hmm.
We didn't increase it.
Yep.
Sorry, I had to sneeze.
Okay.
So,
type.
Thank you. So in these positions, as they started to move our way a little bit this week, and as we rolled forward, what happens is that the amount of capital usage, like in 6E, went down and XOP went down because we reduced our delta risk in there. And by reducing our risk, because we were managing the positions, we also reduced our capital allocation. So we have the same opportunity, but using less capital, which means under normal circumstances, we could put on more positions if we wanted to. I mean, we reduced our capital exposure by almost 10%, or our capital outlay by almost 10%, not our exposure, but our outlay by almost a little over 10%.
I like it.
Let's go to the next slide. And I think this is the last one. And now by managing our positions, this is also really interesting. By using a little less than 50% of our capital, we're comparing this now to a buy and hold strategy in the S&Ps. So if we had a buy and hold strategy in the S&Ps, which obviously would not have worked well in this down move to start with, but the volatility would be 2.2% the first week, 2.1% the second week, and 1.9% in the third week. That's just straight out long SPY.
Mm-hmm. Mm-hmm.
Without adjustments is the middle column, and then with adjustments is the last column. And you can see all we did was essentially improve over 3 weeks by about 25% our the volatility of our portfolio. That means our swings. We never put ourselves in a position where with an adjustment was higher. We obviously reduced, we showed you, we improved the correlation, we improved the amount of credits we took in, we reduced our delta risk, all of the above, and we lowered the portfolio volatility by managing the positions. So every single aspect of portfolio management was benefited, by the rolls into October. Again, we lowered volatility. This is slide 8. We're showing you here how much we lowered volatility of the portfolio. Mm-hmm. Go back to slide 7 for a second, Ryan. No, go back to slide 7. Yes. And we lowered the amount of capital that we're using by over 10%. Go back to slide 6. We improved our probability of profit on 4 of our 7 positions, and we lowered our correlation risk. And go back to slide 5. And in this one, we reduced our delta risk, by over 50%. So you can see every aspect of managing those positions improved our portfolio chances. Now go forward to 9. Thank you. So that's managing positions. Next Wednesday at around 9:05, we'll do scaling up or down so you can use more capital. And that's it.
Nice. Good job. Good job out of you. Good job out of the team. I like the way you presented it. We'll take a quick 90-second break. Sound up. Don't look now. Even the S&P's down 1. You listen to Taste Trade Live. Scott Sheridan next. Oh, boy.